But what I have been hearing, though, is that it has still been difficult to get credit. So talk to me about that and why, what is going on that makes it so difficult to underwrite commercial real estate at the moment, particularly on the lending side?
Sure. I think the most significant thing is the uncertainty. I think we've gotten past the point very early on in the crisis where it was really difficult even to get to an asset, to an appraised, valuations on assets. I think that's getting better the more we open the country to commerce. And so to the extent that the uncertainty comes with, if you were 95% occupied as, say, a retail property prior to COVID, and you're currently 50% occupied, what's the likelihood of you returning back to that 95% at some point in the future, and hopefully the near future? Or is this something that somehow is going to impact? I think the concern always is, it's not just the real estate, it is what does the country look like from a growth perspective and the economy look like from a growth perspective several quarters from now, 2 years from now? Are we going to be in this sort of double dip where you have this immediate impact of COVID that causes stoppage and occupancy rates to plummet, to an environment where that might start to get better, and yet you're in an economic downturn and a recession that could last for several years? And so how do you underwrite to something like that? And it does suggest that you're going to stick to and gravitate toward the asset classes that are more sort of stable. So industrial, for example, I think there are a lot of folks who are looking for industrial properties. Their outlook is good regardless of the economy. You still need to buy things from Amazon, and Amazon needs to ship them from somewhere, right? And they need that industrial, just outside of a city kind of an asset. And so I think that there's going to be continued food fights for good industrial. Office is a very different thing, though, because that goes back to two things. One, do more people just continue to work from home and they decide they need less space? Or two, that they're just not comfortable coming into a city using public transportation to get there. New York City's subways, what's that going to look like? You're protected currently by long-term leases in place for the office market. But when those leases start to burn off, the real question is, do you go back? And if you do go back, do you want the same square footage? Do you want to reduce your sort of, platform such that you can have half your workforce come in, half the week and the other? So to me, it's the uncertainty in underwriting right now in terms of where rents are going, what the occupancy level is going to look like, what's it going to cost to retrofit that space to be COVID friendly, and to be able to fight the virus and have your employees feel safe in that office space. It's almost, and I'm sure folks are doing it as an analyst, I think what you would always do is try to look at any given MSA, what's the square footage or the lease burn off look like in a lot of these office properties? Because when that happens, there is going to be a reset, and it's probably going to be a reset to lower rents. Depends where you are. If you're in an urban area, probably reset to lower. If you're in suburban area, it's probably going to be reset higher. There was a period coming off the great financial crisis where, suburban office was Death Valley. It was really difficult to figure out where you were going to go in terms of getting that occupancy rate up in those suburban markets. Now it's quite the opposite.